Good evening. Thank you for joining us. Welcome to the Startup Path webinar series on the basics of starting your own business. We are delighted to offer these free webinars because we believe that entrepreneurs are the drivers of wealth creation around the world. My name is Sheena Pasco and I am the Director of Marketing for the Startup Path. Before I introduce our guest speaker, I would like to tell you a little more about the Path and the resources that we have created for you. Step 1 features our free webinars where you will learn the basics of starting your business. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of business opportunities that exist. Finding the right fit between your personality and the type of business you start is crucial to your success. Step 3 enables you to learn a business from a mentor. We currently have 18 mentors online who reveal their tips, techniques, and secrets to success in a wide range of industries. We have packaged each mentor's journey and advice into a talk show format that we call the Startup Experience. We are currently in production with 12 additional mentors, each of which will be available very soon. Steps 4 through 6 contain 21 online lessons that cover everything you need to know about starting, growing, and running your business. The featured speaker in today's webinar is the Startup Path's resident expert in entrepreneurship, Dr. Tom Duening. Dr. Duening is the director of the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984 and has started and ran 7 businesses in his career. Dr. Duening has also written 12 books on business and entrepreneurship and has consulted with startups in a wide range of industries. Please be aware you may see the waiting room screen come up again as we transition into Tom's presentation. Today, he will be addressing the topic of business legal structure. It is my pleasure to introduce you to Dr. Tom Duening.
Thank you, Sheena. I'm delighted to be here. Welcome, everybody. This is our first webinar, so we're really excited about this new opportunity to bring entrepreneurial knowledge to all of you out there. We started the Startup Path because we're really interested in helping entrepreneurs realize their dreams. And of course, I've got my own definition of entrepreneurship that I want to share with you before we get into legal structure issues. My definition of entrepreneurship has been developed over about 20 years of teaching entrepreneurship and 27 years of actually being an entrepreneur. And the fundamental thing that every entrepreneur knows in his or her heart, but yet perhaps sometimes just doesn't quite have the ability to articulate exactly what it is that they're feeling, is that you have to create value. Anybody that wants to make money in a Western capitalistic market system has to be able to create value for other people. And of course that can come in many, many different ways. You can create value by virtue of a service that you create. You can create value by virtue of products that you invent. And you can create value in many, many other ways. And people do it every day. And the thing that's the most important, and the reason I think that the Startup Path is such a special venture for me personally, is that we realize that in order for you to be successful, you have to find your fit. You have to have the right fit between your personality and the type of business that you want to get into. Second thing that we're going to teach you is how to retain ownership of the value that you create. And this can be done in a lot of different ways. There is intellectual property. The most important thing is through the legal structure that you create is that you can actually have what we call an equity position in your company. And of course, the more of your company that you need to sell in order to raise capital over time, you become somewhat diluted in that ownership position, but we're going to teach you how to retain ownership over the long term in a manner that continues to keep you incentivized and help you realize your financial dreams that are part of your entrepreneurial dreams. The third thing that entrepreneurs do is they've learned how to minimize risk. And a lot of people think that entrepreneurs are big risk takers, and really that's kind of a misdescription, a misdefinition of entrepreneurs. In fact, entrepreneurs are risk minimizers, and that means that they have learned ways to take the risk out of a deal. Where other people might see a lot of risk involved in some type of a venture opportunity, the entrepreneur has learned how to take risk out of the system. And the legal structure that you're going to choose for your business is partly designed to help you minimize risk, and that is the legal structure can help you protect your individual assets, your personal assets, from the assets of the business. And finally, the entrepreneur has learned how to design a system. So the entrepreneur differs from the small business owner to the extent that the entrepreneur has learned how to design a system that operates without them attending to it every single day. And that means you hire people to work for you. That means that you put in computer systems or you design internet marketing systems or whatever that enable you to go to sleep at night and still generate cash flow for your business. The next slide I want to show you, if I can advance the slides, is about, this is the standard model for entrepreneurship, and you certainly have to have this etched into your mind as an entrepreneur. And if you go over here to the very left-hand side of this graph, you see that at the beginning, and the business is just getting off the ground, you're turning the key in the door for the very first day, and guess what happens? You can see that your cash begins to drain. And you go down into what's called, this is called the valley of death for the entrepreneur, right? And basically at this point in time, you're using your own cash. It's very, very difficult to get bank lenders to give you money at this point in time. It's very difficult to get angel investors or venture capitalists interested in your deal because you're burning cash and you're using your own money until you can find, you know, where the market is. And that's when you begin to see this upturn. And hopefully your business goes long enough for you to get past this point right here, which is called the break-even point. And then that means that you are now bringing in more cash than you're using, and you have an opportunity to be successful. And then, of course, once you get to that point and you don't need money as much, now everybody wants to throw money at you, including the bankers and the venture capitalists and the angels and others. But let's talk about ownership and liability issues and the legal structure. So there's several different terms that I'd like you to learn and just kind of understand as the basic principles of your entrepreneurial venture. Number one is there's founders of your deal, and that means the people that are like you founding a company, and by virtue of the founding, you are going to have some ownership of your venture. And you don't have to throw any cash in to have ownership. Just by virtue of the fact that you're the only one that has an interest in the company right now, you are a founder, owner of the company. And sometimes we call that sweat equity, which means to say that you're earning equity in your business by virtue of the sweat of your brow rather than your bank account. Principals are individuals that come in later, and they could be investors or lenders or somebody else. Typically they're investors that put in money. They're not going to work in the venture. They're not going to be involved in the day-to-day management of the venture, but they will provide you with some capital, and in return for the capital they will get somewhat of a small equity stake in the company depending upon how much of it you need to sell in order to get the capital that you need. So the founders are those who actually found the business, have the original idea, create the value proposition that's going to be sold to the customers, and the principals are the others that come along after the founding of the venture and get ownership for either in exchange for capital or in exchange for real estate or in exchange for some other type of a resource that the venture uses. Here's a couple of issues that are very, very, very important for all entrepreneurs to understand. And that is that there are entities that are unlimited in the extent of the liability that is incurred. Unlimited liability companies are companies that have no distinction between personal assets and business assets. And there are several different legal forms that we have in this country, in the United States, that in fact have that type of unlimited liability. And the point is, it's very, very, very simple to avoid that. In fact, most companies in this country, by far and away, the greater majority of companies that are founded in this country, in the United States, are in fact unlimited liability. And the only reason that they are so is because the owners simply do not know better. They just simply don't know how to protect their personal assets. So we're going to teach you how to create limited liability companies. And we're going to teach you not only how to create limited liability companies, but how to maintain them over time. Because there is a possibility to create a limited liability company and then violate some of the rules that accompany a limited liability entity, and by virtue of violating those rules, you lose your limited liability status. And we have to be very careful to preserve that, because as you go over time and you're building your personal assets, you're buying a house, you're buying cars, raising a family, and so on, you certainly don't want your business interests to cross over so that somebody that might have a claim against your business would also be able to make a claim against your personal assets. So the most common type of business in this country is what's called a sole proprietorship. And a sole proprietorship is a legal structure that simply exists by virtue of the fact that you are doing business. So if you are transacting business with another person or another business entity of some sort, and you haven't declared to whatever state that you're living in that you want to be regarded in some other way other than as a sole proprietor, you will automatically be regarded as a sole proprietor. And here's where a lot of people, I think, fall into a trap, because any type of business transaction that you do would be looked at as a sole proprietorship if you did not have another legal structure that you had claimed with the state. And that's why this is the most common form, because people simply don't know better. So if you're already doing some consulting, if you're doing some transactions with people, helping them move or something in exchange for money, guess what? If it walks like a duck and quacks like a duck, it is a duck. And if it looks like a sole proprietorship and transacts business like a sole proprietorship, in the eyes of the law, you will in fact be a sole proprietor. So of course, there's a lot of advantages to a sole proprietorship that doesn't require any filing with the state. You have complete managerial control, and the business and the owner are in fact one and the same. So the sole proprietorship obviously kind of has the appropriate name there, and that is that you are one and the same with your business, and there's no distinction made whatsoever between the assets of the business and the personal assets of the owner of the business. The disadvantages of the sole proprietorship are in fact that the owner has unlimited liability. It's very difficult to raise capital. There's not going to be anybody that really wants to invest in a sole proprietorship because of the liability issues that are involved there, and it's extremely difficult to hire and keep motivated employees. You can't do any kind of options, stock option programs or anything like that because it simply doesn't exist in the sole proprietorship. The next level of business is what we call a partnership, and a partnership has several different types. We're going to talk primarily here about what we call a general partnership, and a general partnership is very much like a sole proprietorship, and that is a general partnership is two or more people who are transacting business together and acting as if they have a business together, and by virtue of that, guess what? The state and the legal system in the state regards them in fact as a general partnership. There is no distinction made between the assets of the partnership and the personal assets of the combined partners in the firm. Again, this is a very common type. You may or may not be transacting some business yourself right now with somebody that you're working with and say, look, you know, hey, yeah, we've got this little web design company or something, and oh, we're going to go develop a web for somebody, but guess what? You are now exposing yourself to potential liability because in the eyes of the law, if you act like a partnership, you in fact are a partnership and you will be regarded as such, and therefore the decisions made by either of the general partners are wholly committing each of the general partners to that decision. So if you have a general partner that makes a really bad decision and ends up costing a lot of money that the business simply cannot cover, guess what? Your personal assets are put at risk even though you had no part in that decision whatsoever. Each partner is equally responsible for the decisions made by either of the partners in a partnership. So again, you know, this is a form of business that has unlimited liability. You have to be very careful. It is a very old legal form that has existed in the United States since the Uniform Partnership Act of 1914. Therefore, there's a lot of common law that is associated with the partnership legal structure, but it is not recommended. Certainly, it is something that you want to avoid if you are going to go into business with another person. A limited partnership, this is a little bit different. And a limited partner to a deal typically would be somebody that would be registered with the state as a limited partner, and they would be responsible only for the amount of resources that they committed to the company in terms of some type of a claim against the company. This is going to get a little technical, and I know I'm going to race through this a little bit tonight, but the most important thing is for you to understand these different terms and then to go ahead and do some additional research after this. I think you're going to find that most likely the legal form that's going to be the best for you is not either the sole proprietorship or the partnership, but some of those that we're going to be talking about next. So general partnerships, again, very simple to form. If you know it's two people working together, there's no registration required. I often, whenever I see an entrepreneur client of mine that wants to work with another person, I always recommend that they put together some type of partnership agreement in advance of actually operating. And it's much better to have a lot of the decision-making structure in place before you begin to go into business with another person, because there's going to be differences of opinion on a lot of different things, and especially when the business starts cash flowing, that's when a lot of disagreements seem to come into place. And I've been through a lot of partnerships, and early on I didn't do the agreement thing, and believe me, I paid for it almost every single time. So the best thing to do if you're going to go into business with somebody else, whether it's going to be in an LLC, which we'll talk about next, or a partnership or something, make sure you have an operating agreement in place so that you know how decisions are going to be made within the company. So I'm going to just mention a little bit about the limited partnership, and the only reason I do this is because you may have an opportunity to participate in some type of a structure like this sometime later on in your entrepreneurial career. Limited partnerships are typically the structure that is used for a venture capital fund, for example. And that means that those people who are giving money to the venture capitalists are exposed to liability only to the extent of their investment. Those people who are actually managing the money, the venture partners in the company, are going to have business liability. The limited partner will not. Now, what that means is the limited partner cannot in any way participate in the management decision-making of the company. The only thing that they can do is contribute some sort of a resource like cash, and that's the only thing then that is going to be at risk, is that amount of that resource that was contributed. So that's how a limited partnership is structured. And so what we've learned here with this transition from the general partner to the limited partner is the first time now that we've encountered a need to register with the state. Limited partners must designate themselves as such to the state so that the state can tell who it is that's going to be responsible in the case of some type of a claim against the company. A partnership is a little bit more advanced than a sole proprietorship. We did mention that. There's a little bit better chance of raising some capital. You do get to combine managerial skills with other people that join you in your partnership. It's very easy to start, has a very clear legal status because it's been around for now almost 100 years, and there are no business income taxes. So I'm going to use a technical term here that you might want to write down. It's called pass-through taxation. Pass-through taxation. And what that means is for many of the legal structures that we're going to be talking about today, they are taxed at the individual or personal income tax rate. So on a partnership, all of the profits of the company are divided amongst the partners, and those partners then would have to claim their share against their personal income tax. So whatever your personal income tax rate is, that is the income tax rate of your business. The disadvantages of partnership is that the general partners have limited liability. Limited partners in a deal cannot manage. There's potential for disagreements. Anytime you work with partners, it's like getting married, right? You're going to have disagreements about a lot of different things. It can be very difficult to get out of a partnership once you're in it. Typically, if you have some type of an investment that you put in and you say, look, I don't want to be in this partnership anymore, nobody's going to buy you out. Your money is going to be stuck in that partnership until some type of an event happens and everybody liquidates at the same time, generally. There's relatively limited capital available for partnerships. Most investors simply don't like that legal structure. It doesn't give them enough protection. And a partnership is considered by the state to be dissolved if one or more of the partners dies or simply withdraws from the company. So now I'm going to introduce you to probably the most common legal form that is being used by entrepreneurs today, especially startup entrepreneurs, and that is called a limited liability company. And the limited liability company is really the best of the corporate world versus the partnership world. And it has only been around in all 50 states here in the United States since the middle of the 1990s. So it's a relatively new legal form that has been advanced into our business culture. And that means that basically all of the parties in the company, the founders and the principals that come on later, have limited liability. Of course, that means that the assets of the company are separated from their personal assets. All of the owners are regarded as members. Forming a limited liability does require registration with your state. And here's a little known fact, that every state in the United States has a separate Secretary of State office. And if you go online in whatever state you might be in tonight, and you go and you ask for, I'm talking to you from Colorado, so I would say Colorado Secretary of State, and I would probably find the website, and it would say something like business forms or something like that, and I would click on that. And here in the state of Colorado, it costs about $50 to register a limited liability company, and you can do it almost instantaneously. In order for you to get your company up and running and formed, you need to do a name search. You need to make sure that the name that you want for your company is not currently being used by some other entity in the state. And if in fact you do a search and there's no, and the website of the Secretary of State will enable you to do that search. If nobody else has registered that name, you may go ahead and do so, and you can get your limited liability company set up and running tonight if you want to for about $50. And you need to maintain that each year. I think it's another $10 a year in order to be in good standing with the state. And of course, part of that requires the filing of your articles of organization. These are downloadable forms that they'll have, and they might even be completely electronic, where you specify to the state, where your business is going to be located, who it is that's going to be the members of the business, and you might distinguish between what are called manager members and just plain old members. Manager members are people that will actually be operating the business. Limited liability companies have, again, this thing that I mentioned before called pass-through taxation. And that means that the profits of the company pass through to you as the owner to be counted as personal income and then taxed at the personal income tax rate. Now, here's something very interesting. If the business, in fact, incurs losses, and you can demonstrate to your accountant that, in fact, your expenses exceeded your revenues, the losses can also pass through to your personal income tax. So if you are jointly filing as a couple or something, and one of the members of the couple is starting a business and the business doesn't do well in year one, but the other spouse is doing very well, and you file jointly, the losses of the LLC will pass through to your personal income tax filing so that you would pay less taxes. And you need to be very astute about that and work with your accountant to make sure that you are getting all the benefits of this particular legal structure. And further, this is a very important point, the last bullet on this slide, and this is the last technical point that I'll make tonight, is that the limited liability company allows flexible allocation of profits and losses. That means that if some individual that is a member of the LLC has contributed more, either in the form of time or creative capital or actual financial capital, and you want that person to get a lion's share, a greater share of the profits or a greater share of the losses that they can count against their personal income tax, an LLC is flexible in how you allocate those profits and losses that then are passed through to the personal income tax. The advantage of the LLC is, again, the limited liability for owners and managers. It has the pass-through taxation, very flexible. The pass-through taxation can apply to both entities and individuals, which means to say that you can actually have a business that is a member of the LLC. So you can actually pass the profits and losses on through to another business entity. You can have an unlimited number of potential members of your LLC. It's relatively easy and inexpensive to organize. There are companies out there like LegalZoom that have a lot of advertisements on TV, and they'll say, look, we'll get your LLC started for you for $150, or actually it's $350. And I've just told you tonight that you can, in fact, incorporate and get your LLC up and running for about $50. And I think that's going to be pretty much any state in the union that'll do that. So you don't need to use those expensive services. and there's no heavy disclosure requirements. A couple of disadvantages, they're not really that serious anymore. The recent adoption, remember I said the LLC structure has been around only since about 1995. So we don't know exactly how courts are going to act in the case of different rulings that come up. But sometimes some sophisticated investors are a little bit skittish about that. So that might be something to keep in mind. It can be difficult to raise money. Some investors don't quite understand the whole concept of being a member of an organization as opposed to receiving some kind of a stock certificate. And that's kind of disappearing. I do a lot of work with investors, and most of them understand very well what the LLC structure is. And an operating agreement is required, and sometimes, you know, this might engage you with some legal counsel. And of course that'll add something to your expenses, but it can usually be done very quickly. If you find a small business legal counsel, typically it'll have fairly standard form operating agreements already in place with most of the kinds of decisions that you will have to face, and all you have to do is fill in some of the blanks to really fit your specific needs. And you have a very limited opportunity to transfer ownership. Same thing as we saw in the partnership form. I'm going to really just go quickly past corporations. I'm going to assume that most of us out there that are listening tonight are not that interested in the sophistication of actually going to a corporate form. Corporate forms do require that you register with the state. There are two different types of corporation. There's an S corporation and a C corporation. The subchapter S corporation is a pass-through entity, just like all the others that we've already seen. However, it does not allow for the flexible allocation of profits and losses, as does the LLC. The S corporation also limits the number of investors and owners that you can actually have in the company. Typically, state by state, that'll vary a little bit, but in general, it's about 35 people. That's quite a number, so that's really not a limiting factor, but it is something to consider. The other thing about corporations that is different from every other corporate form that we've seen so far is that you actually have shares of stock that you can sell to potential investors, and are issued to the owners of the company. So that doesn't make as much difference as it used to. People understood stock shares and stock certificates that they could hold in their hand a lot easier than they could understand LLC membership, that notion of that. But that's almost disappeared now. After about 20 years of the existence of the LLC and the notion of being a member and so on, it really doesn't make that much difference anymore. Now, if you intend to make your business extraordinarily large and you're going to raise a lot of capital over the coming years, you're probably going to go to a C corporation structure. This is the most sophisticated structure. You'll probably hear a lot of different companies that talk about incorporating in the state of Delaware and things like that. And that's the reason that they do that is because the state of Delaware has the most favorable common law to apply to corporations, their officers, and their investors, and the board members. So a lot of companies, if they think that they're going to be raising a lot of money over the years and are going to get a lot of sophisticated people involved with their venture, will go ahead to a C corporation structure because they want to indicate to even the early investors that, in fact, they have very, very big ideas in mind and they're going to take the business to a very big level. So I'm going to just skip over the C and S corporation. If you want to get more information about this, Sheena is going to tell you in a moment about a course that we have that will give you a lot more detail about the S and C corporation. So at this point, I would like to turn the discussion back to Sheena. Certainly, I encourage all of you to get involved with us at the Startup Path. We're here to help. Get involved with us either by taking our online materials that we've created, or give us a call or send us an email and let us know how it is that we can help you. Thank you very much.
Thank you, Dr. Duening. It was great to learn those details about legal structure. It's kind of hard to believe that companies like LegalZoom charge people up to $350 to set up an LLC when it can be done quickly and efficiently online for far less than that. Dr. Duening did provide a lot of information in this short webinar, but there are many additional details to business legal structure, and we just didn't have time to cover that. Fortunately, we have a full lesson on legal structure available to you in Step 4 of the Startup Path. The lesson is titled Legal Forms, and I urge you to register for Step 4 and learn more about legal structure. Step 4 also includes lessons on writing your business plan and forecasting your financials. It includes invaluable templates that will help you develop your financial forecast and write your plan. Dr. Duening walks you through each step and provides insights into the reality of starting your own business. In fact, for joining this webinar today, the Startup Path is offering a 25% discount to Step 4 or any other item that you wish to purchase at the Startup Path. Write down this coupon code, use it when you check out, and get started today. This discount is being offered only to the first 100 people who decide to take their first step towards success. Of course, the Startup Path, as always, offers a 100% money-back guarantee if you are not satisfied with your purchase. We look forward to helping you reach your dreams through your own business. Please stay in touch and let us know how you are doing. We are here to help. Thank you for joining us this evening. Please note the email address, phone number, and also the coupon code on this last slide. And if you have any questions or concerns, feel free to give us a call or send us an email.